Indian bond yields have hardened after the recent turn of events. First, the Reserve Bank of India raised the repo rate by 50 basis points and gave sober assessment of the economy. Investors now expect repo rate to settle between 6.5% to 6.75% by March 2023. Second, hawkish Fed is expected to continue with 75 basis point hike. This should keep the pot boiling. Third, India's inclusion in the global bond index has been delayed, which has impacted the sentiment. All these have caused government bond yields to harden. Going forward, we expect government bond yields to remain elevated in the near term. Current set of macros point to mild overheating of certain part of the economy. Sharp growth in credit offtake, higher current account deficit, consistent monthly GST collection above 1.4 trillion rupees, and above average tax collections paint a picture of an economy poised to grow at a healthy rate. That said, there are some dark clouds on the horizon. Persistently higher food inflation, mild weakening of the PMI data suggest economy may be losing some steam. Overall, this should keep the RBI on the path of tightening. Global central banks are all looking at the Federal Reserve, which continue to ratchet up rates to contain inflation. Fed fund rate was raised by 75 basis points in third time in September. Recent jobs data point to further 75 basis point increase in the Fed fund rate in November. This has pushed short-term rates of the yield curve even further. RBI Monetary Policy Committee decided to raise the repo rate by 50 basis points to 5.90%. The Reserve Bank of India maintained the FY23 average inflation target at 6.7%, while marginally cut FY23 GDP growth projection to 7%. We expect the RBI to keep raising policy rate to 6.5 to 6.75% by March 2023 amid high food inflation and prospects of a hawkish Federal Reserve pushing global central banks to reciprocate. We expect sovereign bond yield curve to turn flatter going forward. Short end of the curve is getting impacted by upward revision in terminal policy rate, while the long end of the curve experiences strong demand from long-only investors despite heavy supply in the second half. This should push 10-year IGB yield to inch up and trade between 7.47 and 7.62% yield range in the near term. Flatter yield curve and tighter credit spreads provide less incentive to investors to increase exposure to long end of the yield curve at this time. At the same time, short end of the curve remains vulnerable to vagaries of increase in policy rates. Investors should invest in target maturity bond ETF and index funds maturing in the belly of the curve, that is, in segment maturing between 3 years to 5 years from hold to maturity and relative value perspective. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.